It was like the old reflation trade we used to talk about. Basically, commodities up, dollar down, yields up, and cyclical stocks, for the most part, up. A lot of that, I think, was almost the market kind of rebalancing itself after we didn't see the rest of the world fall apart. We got the tariff announcement, and it almost felt as if the market was a little bit too lopsided in the favor of large cap growth heading into the end of September. So that, to me, is how it felt today. It was really the market just holding its gains. It more or less stood in place in terms of the broad market, especially the equal-weighted S&P, up slightly.
You know, what was different this week, actually, is that the rest of the world joined the party. Chinese stocks haven't had their best week in several years. I mean, the FTSE 100 went up on the weaker pound. European stocks
so
ended the week
dismissive of the FTSE 100.
Just the pound and some of the Brexit noise. But seriously, what we had seen was different directions. This week was strong on all fronts.
Yeah, I don't know if it's it's a big tell. Well, I mean, relative to the U.S. market, those markets have done terribly. Sure. And certainly vis-a-vis Europe, we're talking about terrible, i.e. underperformed for the last decade. We're not talking about Europe being, 100 basis points a year behind. We're talking, certainly in dollar terms, down significantly. So whether it's a dead cat bounce or you're going to see some continued strength, I don't know. I think the big question for most investors, at least how I see it right now, is when you reach record highs, do you put money to work or do you kind of stand pat with where you are? And as someone who's 50% in equities right now, I don't see a compelling reason to put money to work at these valuation levels, at least in the U.S.
50%, what's that relative to history? Is that low or high?
That's low. For me, it's low.
And the rest is what, cash?
The rest is in cash or really ultra short-term bonds, so no durations more than a year. So I effectively call that cash. The real issue, most people in their portfolio would have 30% in bonds, somebody my age, 25 to 40% in bonds, and I've just hated bonds for the last few years, and so I wouldn't put any money in that. And basically, bonds this year, if you can, have been a really poor performer in the relative scheme of things.
If you look at the market action this week, Mike, the record highs parade in the S&P and the Dow, and the fact that the global stocks joined the rally, you might have thought there was some big breakthrough on the trade war,
right?
But there wasn't.
No, there really wasn't. It was more that we got kind of a formal announcement of something that just about everybody expected. I think after a while, I've been kind of on this point, the market uses up its worry once it's been around a long time. I mean, everybody who was inclined to think that that was going to be a big, scary event when we imposed tariffs on $200 billion in Chinese imports was probably already very defensive heading into this announcement because we've been talking about it for 6 months.
I think that's, by the way, that's 100% true, and I think you could use me as a good example of that. I thought they kind of pulled a fast one, which I thought was very effective by only making it a 10% tariff as opposed to 25% tariff. So for people who were thinking kind of end of the world trade war, it was kind of less than people were expecting.
Honestly, I think that's a retrospective explanation for why the markets did okay, to be honest with you.
It's a good explanation.
Nobody 2 weeks ago was saying, if it's 10, we buy them. If it's 25, we don't.
I agree.
So I do think, look.
But it wasn't the worst feared.
Nobody said we'll never have to worry about this stuff again, right? Especially if the market keeps going up and people get very bullish and people think that the worst is over for this issue, then all of a sudden a trade headline, a tariff headline could be the perfect excuse to pull back.